Hello, good afternoon. Thank you all for joining us for our last Veterans in Ag Lunch and Learn series. Today we have John Baker and Ed Cox and Beth Graybow, and I am Ann Johans with ISU Extension and the coordinator for Ag Decision Maker, and I'm happy to be able to help with this series. If you have not joined us for a WebEx before, welcome. Along the right-hand side of your screen, or if you are on a tablet or phone, it's maybe along the top or the bottom, you'll have access to a chat box or a Q&A, and through that you can ask questions for our presenters as attendees. You can only see the list of presenters and yourself. You can't see the other attendees, and you don't have access to a camera or microphone, and so just know you don't have to worry about us being able to see or hear you. You can only see and hear us. And if you have any questions or tech issues, be sure to type those in the chat box, and we are happy to help you with that. So with that, I am going to turn it over to Beth to introduce our speakers. Thank you.
Thank you, Ann. So welcome, and thank you for joining us today. As Ann said, my name is Beth Graybaugh. I'm with Veterans in Agriculture, and our organization is a nonprofit that is based in Urbandale, and our mission is to help veterans thrive in agriculture. And so I really work to connect veterans and active military with resources and information. So I'd like to thank Iowa State University for providing all the support for this series. And then this project is also supported by the North Central Extension Risk Management Program and USDA, excuse me. So today we have got two presenters, and I'd like to welcome them both. So we're going to begin, although their introduction is probably going to be a lot the same. We're going to start with John Baker. He's an attorney on staff with Iowa State University. He's a veteran, and he is a former board member of Veterans in Agriculture. So welcome, John.
Thank you. It's nice to be here with fellow veterans looking at their future in agriculture. It's something that I've been interested in for over 30 years. And as I put up on the slide, you can see that I was in the Marine Corps.
Oh, wait, John, we have to share your slides again.
Oh,
sorry.
Okay.
That was practice steps before, and so now we're going to do it for live.
Okay.
Did you find them? So along the bottom, you'll have share again.
Okay.
Okay. And just hit that display settings to switch the two.
I don't think that's the right one, was it?
So go up to display settings at the top.
Okay. No, I don't.
So remember at the top it says show taskbar, display settings, and then in slideshow on the presenter mode side.
Nope. No, okay. Let's. Here we go.
Okay.
There.
That looks great. Okay.
Okay. Well, that's the risk that you run when you're dealing with somebody who was born on the wrong side of the digital divide. This is all wonderful and confusing at the same time. Well, in any event, you can see what I want to talk about is why I have a business entity, and it's a pleasure to be here to speak with you all when you're thinking about entering agriculture. It's something that's interested me for most of my professional career as an attorney, and I put on there that over, it doesn't seem possible, but over About a half a century ago, I was in the United States Marine Corps, and probably if you can see me, you kind of probably find that hard to believe, given that my age now. What are the reasons for having a business entity? Well, one thing, it provides for a focus on the business management. The fact that you have the entity will cause you to think more about the business and the management of the business. It creates records that are going to aid you to manage effectively and efficiently, rather than running everything through one checkbook that may also be your household checkbook, or now I guess wouldn't be a checkbook, but necessarily, but perhaps a debit card, and that is it separates those out. It provides you with records for financial analysis to see if you are being efficient and effective in your financial management. One of the big things is it helps you manage risk, and I'm going to talk quite a little bit about that. And then there's three more that I think are included, and I'm not going to mention too much about those. The first is it assists in business succession planning, moving the business generationally, and it also may help you out in some estate planning, and it may reduce some taxes. Well, providing focus, it separates the business activity and assets from all your personal activity and assets, and that can be very important, not only for risk management, but just for management itself. Creating records that aid you in managing efficiently and effectively, that's where to spend your time and energy in the business. If you have multiple enterprises and you want to focus on those that are providing you with the bulk of the income, and you may have some enterprises, or some may have started an enterprise that you decide to end because you can see that it is not providing any income, and indeed may just be providing an expense with no income to offset it. And then provides records for financial analysis. Not only are they help in managing, but if you're going to obtain credit financing, you're going to need to have those kinds of records, and not only for the current year, but for several years, you want to be able to show a trend. And also then they're available to help you calculate taxes. It helps you manage risk. And the thing about risk is that it cannot be eliminated in business. I guess the only way that you actually could eliminate it would be if you decided not to go into the business you're contemplating going into, then you wouldn't be subject to any risk of that business. And since risk can't be eliminated, we need to manage it. And that's what we're going to talk a little bit about. And then the other three, as I mentioned before, that I'm not going to go into, be kind of beyond the scope of what this talk is about. Well, some initial considerations about forming a business entity. The first is how's it formed? Do you have to file anything to form it? Agreements? Are there bylaws? Are there operating agreements? The things that Ed will cover in a little more detail. How's it owned? Who's going to own the entity? And how's it managed? Is it managed by the people that own it, or a professional manager? And how are profits and losses allocated? Who gets the profits? Who gets the losses? And how are they distributed? So there's one thing, we're going to allocate the income, or the profit, but are those profits being distributed? How are ownership interest transferred? And one of the important ones is how is a business entity brought to an end? If it's easy to get some of these things started up, but it may be more difficult than to wind up the affairs of that business entity. And so we need to think about those initial considerations. Well, what is risk management? It is the identification, evaluation, and prioritization of risks, followed by a coordinated and economical application of resources to minimize, monitor, and control the probability or impact of an unfortunate event, or maximize the realization of an opportunity. So a lot of words there, and we're going to break those things down and make them a little bit more understandable. But clearly, one of the things you have to do is identify what are the risks. You have to evaluate them. You have to put them in a priority, and then you have to strategize on how you are going to deal with those risks. What management practices are you going to put in place? So you have to analyze the vulnerability of a critical asset to a specific risk. So what is the risk that you're trying to manage? And as you analyze the risk, I think there's three things to consider. Some risks are there's a probability. In other words, this is going to happen. We just are not sure when, but we know it's going to happen. In farming, that might be a market failure or a crop failure. It might be interest rate fluctuations. And so those are things that you can assign a probability to. Crop failures due to droughty conditions. Well, we can kind of know that droughts tend to be in cycles, and so we can look at those types of things. Then there's risks that are possible, and those are ones that are difficult to assign a probability to, but it's possible that those things can happen. It's possible to have an accident. It's possible to have an illness of a principal in the business that's necessary. And so those become a little bit more difficult to manage in terms of risk management. And then there's this thing that is called this black swan event. The vast majority of all swans are white, and they're born white. But occasionally one shows up that's a black one. When the egg hatches, it's a black swan. And you can't tell when that's going to happen. It just pops up out of the unexpectedly. It's not probable. It certainly is possible, but it's a very remote possibility. And those black swan events are the ones that are very, very difficult to risk manage. But there's certainly things that we need to consider. And then what are the consequences of the occurrence of the risk event? Is it something that puts the entire business at risk? Is it something that has an effect on profit? Is the effect on that profit great or small? So it is if this risk event happens, what's the consequence? Then you have to identify ways to reduce those risks. What are we going to do to reduce a risk? And so if you have you think about the risk of the loss of an asset due to destruction by storm or by fire, well, one of the ways you reduce that risk is through having insurance that will help you with those replacement costs. And then a prioritization of the risk measures. So where should we be spending our time and money in trying to reduce risks to a manageable level? The other thing is, what's the context? So observing the context, what's the social scope of risk management? Who's going to be involved in it? Is it something that is internal within the business? Is it something that needs to be thought of in an external way to the business? Are there other entities that are going to be involved? What are the objectives of the stakeholders to the business? And stakeholders are not only just our business principals, those that have an ownership interest in it, but they're also creditors and customers and suppliers, and their objectives for your risk management strategies might be different than to some degree than what yours are. So they have to be considered. and then the basis upon which all risks will be evaluated and the constraints of those evaluations. And so knowing that you can define and evaluate a risk within certain parameters, and those parameters need to be applied to each one of the risks so that you're comparing apples with apples. Then defining a framework for activity and an agenda for identification. In other words, what we're thinking about there is we need to have consistent ways of managing. We can't you can't have comparability in a set of records if you don't keep the records the same way. So you can't have comparability and security established through risk management if every time you go to define the risk, you use a different set of criteria and then a different agenda for establishing priority in that. So the idea of management is to have some well thought out, consistent way of doing it. And then the analysis of the risk involved in the process. So we need to analyze those risks in a consistent way. And then finally, what are we going to do to mitigate the risk using our available technology, the human resources and the organizational resources that are available to us? And are those, thinking back then to the whole idea of what's the context, are the humans involved in the risk management strategy, have they been consulted, and are they in agreement with adopting that strategy and management plan to mitigate that risk? So the last thing that I kind of wanted to talk about was what are some of the things that you get when you have a business entity and you manage risk? Well, your entity will help you improve the management of your farm or ranch or whatever you're doing. If you're looking at a long-term operation, it's an easy way to, it may help you figure out how to transfer that farm or ranch to an heir. And that heir may be someone who is related to it, maybe a key employee. How do you bring someone into the family business or into a closely held business? Do they have to buy their way in? Can they work their way in? It's a way to limit liability. And when we think about liability, there is, if you are driving your tractor across your land to do some operation, your liability there for is much less than if you're also have an enterprise where you're hauling grain out on the highway for a neighbor. That liability is much greater. And so you need to think about how do we limit that liability? How do we capture that liability? And one of the ways we can capture it is in a business entity, so it doesn't put our personal assets or other business assets at risk. And if you're going to expand your operation, is it something that ought to have its own entity to help manage it and to isolate the liability and to raise some capital? You may want to make some gifts. This is an easier way to do it through ownership interest. You may need it to comply with state or federal laws, and then it may or may not reduce your taxes, depending upon the kind of entity that you have. All too often, we may prioritize the reduction of taxes when that may have a marginal impact on your business, and it may have a marginal impact on your risk management strategy, but it may have a very great impact on some other things, such as your ability to transfer the business to another generation or to raise capital in that. So we need to think about each one of these and analyze them separately. So that's my contact information. If you call that 800-447-1985, if one of our counselors is going to answer the phone, tell them that you heard this talk, that you would like to have me give you a call, and I will return your call. So with that, I'm going to turn it over to Ed, who's going to walk you through the kind of the nuts and bolts of putting together the business entity and the various business entities that are out there.
Great. Thank you so much, John, for that. So I appreciated your comments about that risk can't be eliminated, that you need to manage it. So I appreciate that information. So our next speaker is Ed Cox. He is an attorney in Centerville, Iowa, down in southern Iowa. He is a veteran, and he also served on our Veterans in Agriculture Board. So I appreciate him taking time out of his day to present us some additional information. So I'll turn it over to Ed.
Thank you, Beth. And let's see, just looking for my PowerPoint here. There we go. Okay, can everybody see it okay?
That looks good, Ed.
Okay, and I'll start with a brief introduction. As Beth mentioned, I'm a veteran. I served in the Coast Guard from 1999 to 2003, and then went to law school. Worked at the Drake Agricultural Law Center there at Drake University for about 5 years, and then I've been in private practice in Centerville ever since. Had the fortune of working with Beth and John through my work at Drake, which was enjoyable, and then as well on the Veterans in Agriculture Board. I think we had a question, and trying to see how to see those now, but it was basically what are the pros and cons of having a name that you're doing business as, or a DBA designation, and doing business as a name. I mean, there might be some marketing benefits to that. It's not really going to provide you with any liability protection or anything like that unless you actually go through the steps to form an entity such as an LLC or a corporation, and file with the Secretary of State's, and you actually have that entity set up. If you're doing business on your own, but you're doing it under a different name, you're still going to have that liability exposure. So let me know if you have additional questions in that regard. And I don't see the comments, but if Ann or Beth, if you see one come up, feel free to interrupt me during the slideshow, because I like to get feedback and have questions during the presentation. That doesn't bother me in the slightest.
I can do that.
Okay. Okay, so as John said, I'll cover more of the nuts and bolts of actually setting up the entities and things to think about in terms of risk management while you're setting them up. The biggest thing that people like to know about in terms of risk management, or even just generally speaking in terms of the setting up of an entity, is the liability protection that it provides. The second question is in regard to taxation usually, and how that works. But we'll cover the types of entities, the limits on liability protection. So it's not endless. There are ways that you can still be personally liable for your actions. As John mentioned, we'll talk about agreements a little bit to see what should be in those, whether that's your bylaws or operating agreement, if it's a LLC. The importance of including purpose and scope in those agreements, management authority, and then as John mentioned, the importance of getting in and out of the entity. So if you've got people that want to get in, how is that handled? If you've got people that want to get out, how is that handled? And what goes along with that is succession, thinking about long term, and if you've got children or others that you see coming into the plan later, or the business later, how that's going to be handled. So we'll start with the types of businesses. These are the main types: sole proprietorship, partnership, limited liability partnership, corporation, limited liability company, and I put in not-for-profit corporation. I don't know if anybody's interested in that, but it comes up sometimes in these topics. It's a little bit different, but I thought I'd mention it just because I get asked about it fairly often. So no matter what, if you're doing business, you are one of these things. If you do nothing and you're conducting business as yourself and nobody else is involved, you're a sole proprietor. So that's what you're designated as. You don't have to file anything. In fact, you wouldn't file anything, but that's how you're going to be thought of, legally speaking, under the law. You're going to be a sole proprietor. If you're doing business with someone else or other multiple parties for a profit, then you're going to be a partnership. And we'll talk about the differences there and the need for, if you're interacting with other people in your business and it looks like it could be a partnership, the importance of defining that in some type of agreement if you don't want a partnership, so that there's no mistake in that regard. Then there's the types of businesses or entities where you have to file something with the Secretary of State, take some type of active step in order to become one of these entities. And this is where your limited liability comes in. So we have the limited liability partnership, which is very similar to the partnership. It's just that you file with the Secretary of State. The corporation, that requires filing, the limited liability company, and the not-for-profit corporation. So those are
Ed, since you asked for interruptions, I do want to ask, sometimes we get people who are from other states. Is this the same no matter where you live with the Secretary of State and applying through that process?
Yeah, it's pretty similar across states.
Okay.
As soon as I say that, I mean, there's 50 states, so there could be some kind of outlier or something, but yeah, these are pretty common. The only one that's kind of different from state to state is there's now what are often referred to as B corporations. These are kind of a cross between a for-profit corporation and a not-for-profit corporation. So what that does is allows for the ability for the owners or managers, directors of the corporation to not just focus on the money aspect and making a return for the shareholders, but to do things that benefit the community or the environment, those types of things. So those are something that are fairly new. I think they've been adopted in over 30 states, but that's something that's not across the board. So sole proprietorship. If you're all by yourself, then you are a sole proprietor. There is absolutely no separation between you and the business. Your assets are considered part of the business, or I guess the business assets are yours personally, and all of the actions that you take are part of the business. So if you do something while conducting your business, any judgments against you, claims, debts, anything like that, they can come after that. So if you've got a creditor or someone, if there's an accident and you have someone that has a claim against you or a judgment, they would be able to come after your personal assets. Obviously, there's no formal requirements for establishing this. You just start doing business, you are a sole proprietor. And of course, you're taxed individually because you don't have any separate entity. So any income that comes in, it's going to be reported on your personal tax return. Same for losses. Partnership is very similar. The legal definition is a voluntary association of two or more persons who jointly own and carry on a business for profit. So if you're working with someone else to make a profit and you're essentially sharing in the risk, you're both contributing to that business, and then you're both receiving distributions, that can be viewed as a partnership. And important to point out this legal presumption, because if you're working with someone else and you're sharing in the profits, there's going to be a presumption that you are a partnership. And this could be a problem for you if you don't intend for there to be a partnership. So you may not have any intent, but the public may not know that. So if you're out there doing business and someone else is involved, you may be opening yourself up to liability for their actions and what they agree to. And so, where this could be a problem is say you're sharing equipment with someone is lending you equipment or leasing you equipment, but you don't have it clearly defined on how that's structured, that it's a lease of equipment and that you're not working together for the profit, but you are, you're leasing the equipment and then you give them part of your profits in return for that. So that's just an example of where you could run into difficulty and the lines could be blurred. So you want to make sure that those lines aren't blurred. So if you don't have an entity out there and you are working with someone else, make sure those are defined so that you've got a written lease or, whatever the agreement is with the other party. Again, just as with sole proprietorship, you haven't done anything to incorporate this business. So anything that you do is going to put you at risk, your personal assets at risk. There's no difference between what you do and what the business does. And it's also important to know that all of the partners are liable for all of the business claims, and that each partner is liable for the entire obligation. So say there's a claim, again, you're in a partnership with 3 other people and someone has a claim against you, against the 3 of you, and they get a judgment, then if the other 2 partners have no assets to pay, they're going to look at you, whoever the judgment holder is going to come after all of your assets in order to satisfy that obligation. So they're not required to say, okay, well, you've given a third, so that's it. They can come after you for the entirety of the judgment. It's also important to think about management control in these situations. If you've got a partnership, any partner can bind the others on behalf of the partnership. So, you're putting yourself at risk for the acts of others there, your personal assets at risk. Even if you don't have an entity set up, you can have a partnership agreement at least, and that would be advisable certainly. Obviously you're going to recognize what the name is, purpose and scope. We're going to talk about the importance of that later, but you can identify what it is that this partnership is supposed to be doing, what is it not supposed to be doing, how you're each going to contribute, and in turn, how you're going to receive distributions. And then also setting forth management authority and the limits on that authority. Then if you don't have a partnership agreement, Obviously, this is what can occur. Disputes, misunderstandings. And I just kind of like this picture just because there's the one kid that's just saying, okay, calm down. It's all right. But you don't want to be in a situation where you're not understanding one another. There's hard feelings. And then when things go south, you don't have any mechanisms in place to separate. Taxation of a partnership, just like the sole proprietorship, there's no difference between the income that comes to you. It's going to come to you based on what you receive through the partnership. So if you're in partnership with 3 people and you're splitting everything evenly, then you're going to file your individual tax return and report that 1/3 of the profits or losses.
What do a husband and wife fall under, either sole proprietor or partnership?
Well, if they're doing business together, I don't think that there's any difference. They're not viewed as a single entity, so I think you'd have a partnership there. Yep, if they're both involved in the business. And if John, if you have any input on these questions as well, feel free to jump in.
I did mute, but I muted John. I'm sorry.
Okay.
There was a little bit of feedback from his mic, so there he unmuted himself.
Okay.
I won't be bashful, Ed.
Thank you.
All right. Sounds good. Okay, so now we're getting into the things where you have to take some type of active step in order to set up an entity that is separate from yourself. So the limited liability partnership, very similar to the partnership we just talked about, except that you have limited your liability so that the partnership is considered a separate individual and that your personal assets are not at risk. So then you can certainly lose what you've invested in that partnership, but not more. And all you have to do is file a statement of qualification with the Secretary of State, stating that you are an entity or the partnership is an entity. And then, there'll be information in there on how you can be contacted and served. It's pretty basic information. Certainly adopting a partnership agreement is valuable there as well, just like it is in any partnership. So then the corporation, this is often what people think of when they think of business entities. LLC is becoming more and more popular. Probably more people set up as an LLC than a corporation, but this is kind of the classic situation. So with the corporation, the ownership of the corporation is with the shareholders. So you own shares of the corporation. You may own all of the shares of the corporation, or you may own a percentage of those shares. Management is controlled at the first level by the shareholders, but they elect directors or officers to make management decisions. So it's kind of split here. And so when you're a shareholder, if you've set up a corporation and you're the only shareholder, most of the time we just have the person elect themselves as director and possibly president if they want to use officer designation to make the decisions. And then that's how it's done. The shareholders control the broader management decisions, such as adopting the bylaws and that type of thing, whereas the directors do the more day-to-day. So it can be, yourself as the shareholder. It's usually the way it is in small, closely held corporations where you've just got 1, 2, 3 members. The shareholders will elect themselves all as directors, and then you have all of the management decision making. Of course, with the corporation comes the benefit of the limited liability. So now the corporation is separate from yourself. So you've got certain assets that will be in the corporation. Those may be, equipment, tools, certainly bank accounts, could be land, although we'll talk a little bit about separating, your main assets from the corporation. So, if the whole purpose is protecting your assets so that if somebody has a claim against the corporation, they can't come after your personal assets. So you probably don't want to have the land that you own, if you're owning land, which is probably your most significant asset, in the name of the corporation, because then if you do get a judgment or a creditor against you, they would be able to come after that asset. So usually the way we do it is you'll continue to own the land in your name or a separate entity, and then your corporation or your LLC will rent that land from you. There's also tax benefits to that, but you can talk to your tax advisor about that. The way you set up a corporation is file articles of incorporation with the Secretary of State. This is usually a 1 or 2 page document. It's very simple, and it's stating that you are an entity, and again, where your primary business office is located, and where your registered agent is, or the person that can be served if somebody does have a claim against you or some legal matter. And then, so as opposed to a partnership agreement that we talked about a little bit before, a corporation has bylaws, right? So you're going to want to adopt those bylaws, and that's basically the constitution of your corporation. It says what your rights are, what your duties are, how the corporation is to be governed. The corporation is taxed by default on on the income received. So here the corporation will have its own tax return, and it's going to pay income taxes. And then as the shareholder, if you get distributions or dividends from that corporation, then you're going to be taxed individually on your individual return on that income received. So there's a possibility here with the corporation of having double taxation, right? Once at the corporate level and then once at the individual level. However, you can elect to be an S-corporation, and an S-corporation is taxed like a partnership, or like most LLCs, where the profits and losses pass through the corporation to the individual owners. And so what that means is you're not going to be filing a corporate tax return. You're going to be filing any of the profits or losses on your individual tax returns. The other thing with corporations, and when you're trying to select, do you want to be a corporation or an LLC or a partnership, taking into account the formalities. The most formal form is the corporation. So you're issuing stock. Now that doesn't necessarily mean that you're getting your paper with the name of the corporation and everything on it. A lot of times now this is just kept electronically. But you do need to keep track of transfers of stock and how much stock there is, how much is owned by the corporation. You have annual shareholder and directors meetings. You need to keep minutes, particularly of major decisions. Make sure everything is signed as an officer or director of the corporation. And we're going to talk about, if you don't follow these steps and these formalities, how that can put you at risk personally for not acting like a corporation. So it's not just a matter of, with a corporation of filing it and then saying, okay, I'm done, now I can do whatever I want. You've still got to have separate bank accounts, detailed financial records. You can't just continue to use your own personal checking account. You need to treat it like a separate business entity. The limited liability company, on the other hand, is a little less formal, and we'll talk about that in a little bit. This is, perhaps you and others want to own the business. It doesn't matter. You can have it. You can be 100% owner, or you can share with other members. You're going to have membership interests rather than shares in the company. So that's usually just on a percentage basis. You have 50% ownership, or you have 100% ownership, whatever it is. And then you as owners are called members, as opposed to shareholders. Management can just be the members getting together and making decisions. So then you're a member managed LLC. Or you can elect managers or officers to make those decisions and be a manager managed LLC. Usually we have at least officers elected to make decisions. A lot of times, banks, or if you're doing real estate transactions, they're going to want you to sign as manager or president, something like that, that kind of designates that you have this management control. In terms of limited liability, it does the job. It separates your business actions or liability for what you're doing as a business away from you as an individual. And so again, your assets are not at risk, your personal assets are not at risk. And again, that's where you have to maintain that separation. So if you've got personal assets, but you don't keep those in your name, you put them in the name of the limited liability company, then that defeats the purpose. And you can only lose what you've invested. So in order to make this happen, as opposed to the articles of incorporation for a corporation, you file a certificate of organization with the Secretary of State. And again, this is a very simple document. It's stating that you're an entity and where your principal place of principal office is and how you can be served, where your registered agent is located at. And then you'll adopt an operating agreement as opposed to bylaws, but it's essentially the same thing. It's going to tell you how to govern your LLC. And when I say how to govern, that's how officers are elected, how profits are distributed if you've got more than one member, and then we'll get more in depth on how to, limits on transferring and succession and that type of thing as well. Taxation of the LLC, sole member LLCs are taxed like a sole proprietorship. It just passes right through. The LLC does not file a tax return. LLCs with multiple members are taxed like a partnership. So the LLC, whatever profits go to you based on your membership interest, are taxed to you personally. So you're going to get what's called a K-1 from the LLC, and that's just a form stating what income is attributable to you, and then you can file that on your personal tax return. You can't, LLCs can elect to be taxed as a corporation where they do pay taxes, but that's only beneficial in limited circumstances. If the LLC is going to be holding a lot of cash and not distributing it out to you, you may want to do that, but that's not very likely. And so we've got a less formal structure for a limited liability company, which is why a lot of people prefer this. So instead of the guy with the tuxedo, here we have the overalls. It's more of a working entity where you can disregard some of the formalities, not all of them. But you don't have the stock to issue. Again, you're just going to keep track of the membership interests. It's still important to keep minutes of major decisions so that you have a record of that. Documents, again, need to be signed as member, manager, or officer of the LLC, however it is that you make decisions. You don't want to just put your individual name on it rather than the LLC. You need to have that LLC name on there if you're signing stuff. Now, a lot of banks are going to say, okay, well, we're going to lend you this money. It's fine. You want to, borrow as a limited liability company, whatever your name is. But they're also going to want you to sign personally. So they may require that before they give you money. And if so, that's fine. But just remember, when possible, and you're doing business as your LLC, sign as the LLC. Keeping detailed financial records, John mentioned that as well, and the importance of that, as well as keeping separate bank accounts. Again, that keeps it separate from you personally, so that there's no confusion about what belongs to the entity and what belongs to you. It's also nice so that you can track income and expenses, and there's no confusion there. It'll make doing your taxes a lot easier. I said I'd mention not-for-profit entities. I'll just briefly discuss that. There is limited liability, but that's because you don't own this entity, right? So a not-for-profit is set up, and you may be an employee of it, you may be on the board of directors, but the management is done by the board of directors, and they hire officers or other managers to do the day-to-day management. There's no profits to distribute because it's not for profit. You may have a salary as an employee of the not-for-profit, but you're not going to just have a share of any money that comes into that not-for-profit. You file articles of incorporation just like a regular corporation and adopt bylaws. But then you're also going to need to file a 1023 application with the IRS, which is a pretty lengthy form and does take several months to get that approval. And I definitely talk with a tax advisor or attorney about that if you're interested in it. So when you're managing risk with a limited liability entity, obviously you need to know what some of the exceptions to that limited liability are. We've kind of talked about this before, but when you treat the entity as just an extension of your own personal affairs and not as a separate entity, then people can have their judgments attached to your personal assets, and that's called piercing the corporate veil. So it's essentially saying you're acting like this is an entity, but it's just a veil. You're actually just doing everything as an extension of yourself. So this is where it's important to follow those formalities, keep everything separate, especially bank accounts. Make it clear what assets belong to you, what assets belong to the corporation. Adequately fund the corporation. So, you need to have that working capital staying with the corporation, not draining everything out, so that, you're constantly moving funds back and forth between yourself and the entity. Holding the required meetings, important to have annual meeting with corporations and have minutes of that. Election of officers. I mentioned keeping separate accounts and paying expenses through the corporate or LLC accounts. Also, it's not going to protect you from liability if you're careless yourself. So if you are negligent in the way that you're behaving, so an example that I hear John use a lot is if you're hauling feed or whatever you're doing on company time, if you're driving down the highway and you're intoxicated, this isn't going to help you. So you're still going to be personally liable for those actions. And it's the same thing with negligence or purposeful wrongdoing. You can certainly still be held liable, even if you're doing something on company time or for the business. If it's your personal actions that cause the damage, you're going to be liable for that as well. Now, most likely what would happen is they're going to sue the corporation or the LLC as well as yourself. And then obviously, as we talked about, if you sign for something, if you sign a note to the bank as the LLC or corporation, as well as personally, of course, you're personally still going to be obligated there. Okay, so having written agreements and structuring those, that's a key element for managing the risk when you're dealing with an entity. If you don't have things spelled out, then you know, well, we'll talk about examples, but essentially there's going to be some default rules just because all of these are statutory entities. So there's a code section governing corporations, there's a code section governing LLCs, and as well as partnerships. So you're going to have some rules there. But if you want to be in control of how it's governed and how the dealings between the partners or the members are governed, then you need to have it written down. Obviously, you're going to have your name in there. Oops. You're going to have your name, the name of the corporation or the LLC is going to be in there. The purpose and scope needs to be detailed. And it may be that your purpose is doing any business that is legal, and there's nothing wrong with that. You can have a very broad scope and purpose. Where you need to pay attention is if you're in business with other people and you or they have other business interests. So say you've got one farm that you're farming as an LLC with a sibling, but then you also have your own processing business or whatever. You need to make sure that if there's conflicts between those, that it's spelled out what the scope of those are, because you have a duty of loyalty to every entity that you're involved in. And so if an opportunity arises that would be great for this business that you have with your brother or your sister, but you kind of want it for this business over here, you know, how does that work? Which should it fall in? And there's ways to deal with that in the purpose of and scope clause of your bylaws or operating agreements. But it does need to be spelled out if that's a possible problem. Otherwise, you've got another partner or a member coming and saying, hey, you took that for yourself. That should have been an opportunity for our business. Certainly need to spell out the contributions for each member or shareholder, and that reflects the ownership as well as the distributions that are made. And this seems obvious, but I put it out there because, you know, most of the time people think, okay, well, we're all contributing $50,000. You know, so, you know, 50,000 from you, 50,000 from you, 50,000. We all own a third. It is possible to give ownership interest based on non-financial contributions. So if one person is doing most of the work, you can put a value on that and say, okay, they're contributing this amount of time, so they're going to have this ownership interest. And then that interest will be reflected in the distributions that they receive. Again, management authority, clearly delineating who can make decisions, who can bind the partnership or the LLC, whatever it is, to certain obligations. If that can just be one person, or if you have to have a vote on it, particularly when you're dealing with, you know, transferring large percentages of your assets, then you're going to want to have you know, maybe a unanimous decision as opposed to something that just an officer could do. Transfer of shares or interest to third parties. So this can get sticky, right? Because you all own your shares or your ownership interests. Maybe one of you says, hey, I want to sell my shares to my buddy. And the others are like, oh, I don't know about this person. They may not want to do business. So having some mechanism in there that says, you know, if you want to sell any of your shares or transfer your shares, gift them, whatever, maybe there are certain people that you can do that with without any kind of limitation. Maybe you can transfer it to your children or other family members without any limitation, but not non-family members. You know, you can, but first you have to give the corporation or the LLC or the other members a right of first refusal to say, oh, you're going to transfer it. Okay, well, we're gonna buy them first. And this falls hand in hand with having an exit strategy for owners. This is something that can get very litigious and problematic if you don't have a buy-sell clause in your bylaws or your operating agreement, whatever it is that governs your entity. And so essentially what that is say someone wants to get out, or someone dies, what's going to happen to their ownership interest? Can that just go to their heirs or whoever they want to sell it or gift it to? Or are they forced to sell that to the corporation or to other members or owners of the entity? This is also where it's important to keep in mind the importance of record keeping and knowing what assets belong to the entity and what the value of those are and how income is distributed. Because if you're doing it informally and say it's a family corporation and you know, everything's going well and you're all just taking out whatever you need from the corporate bank account to you know, pay your bills on your house, pay utilities, get groceries, that type of thing. And then all of a sudden somebody wants out, it's going to be a problem. And you're going to have to figure out who owns what, who's received what, and that can get very litigious and very expensive. So you certainly want to address those things if you want to manage risk, even if you have an entity. And I think that is all I had.
Thank you so much. So I just have a few questions. I know we are kind of right at that 1 o'clock hour. Uh, thank you both so much. And I think that John's comment really encompasses this whole series. And Beth mentioned this too, and I had it written down too, that this whole series has been about how to manage risk because it is unavoidable. And both of you are just a wealth of knowledge. And so I'd encourage those listening that if they have very individual questions, because sometimes you do, right? These are very unique situations most often, that if they wanted to get some more information, they'll have your contact. But a couple questions I have. So since I both have you on here, and like I said, you're both a wealth of knowledge, I would like your thoughts on what is the most common issue that seems to occur in business planning that is easily unavoidable?
Well, I'll take a shot at it, and that is the failure to put into writing what you're agreeing on. We all suffer from the same ill, and that is that I will remember what's important to me, and you'll remember what was important to you. And a year from now, if we get into a dispute about what we agreed to, I don't remember agreeing to what you want, and you don't remember agreeing to what I want. And that's when, as Ed said, it gets very litigious after that. When you put things in writing, it causes you to think more carefully about the words that you use, because the written word doesn't have any vocalization to it. It doesn't have any emotion attached to it that we get from face-to-face conversations. It doesn't have any of those things that we read into a conversation based on facial expression, based on tone of voice, posture, all of those things, cues. So we tend to be more careful as we write these things down. And the more that you list out, the better it is. Now, two things that I often hear. One is that, my word is good. Well, I know that. That's why I know it's not going to bother you to put it in writing. Okay. The other thing is, in the good old days, we did it on a handshake. Yes, and both Ed and I can show you several thousands of miles of bookshelves filled with cases where those handshakes wound up with people suing each other. So if your goal is to make the business flourish, then keep good records and have it well understood. But the biggest thing is people just don't put things in writing and keep the records.
Thank you. Ed, do you have anything to add to that?
Yeah, I would agree that that's probably the biggest thing. And the only thing I would build on with that is talking to an attorney. And I'm not doing that to advertise for attorneys, but it's probably one of the best insurance policies you can buy is spending a few $100s to consult with an attorney, get it set up correctly, get some information about how to manage things, and that those written documents are what you want, and that there's things that are thought of by attorneys that you may not think about, because we have witnessed those cases that John talked about. So I think probably just getting an attorney to review your documents, or to consult with an attorney, so that those written documents are enforceable.
Thank you. So that actually kind of leads into my last question, which is, as we wrap up this series, I think the importance of that professional team for farm business owners. And so would both of you kind of like to talk about the people you would encourage them to have on that team?
Well, certainly I agree with that. I think you need to have an attorney. It's not a question of whether someone is intelligent enough. It's a question of is that your area of expertise? When I was young, I used to work on my own cars. Now, when I pop the hood on them, I don't recognize anything. So I don't work on my own cars anymore. I lack the expertise to do it. So I have to pay somebody to do it. So, hire people that have that expertise. I would think, and one other thing, ask questions of that expert person. And if they are hesitant to answer it, remember, they're working for you. Hire somebody else, right? So I think an attorney, I think certainly at some point, probably a CPA or a good tax preparer would be a good one. Identify expertise that's available through your extension service. We've got farm management specialists. We've got livestock specialists. We've got crop specialists. We've got practically anything you can think of in your business. Ag engineers, there are people out there. So do the same kind of research in setting up who your experts are going to be as you did in setting up your business. And selecting those right people it is part of that whole risk management strategy to reduce liability.
I would just add, talking to USDA, Farm Service Agency, and NRCS to get them involved, and then not being afraid to interview multiple advisors, whether it's your attorney or CPA, and find out what their experience is, and are there skills and knowledge does it match what you need?
Yeah, I guess one of the other last things I would add is find some mentors. Find people that are doing what you're doing. So, not necessarily the exact thing you're doing, but if you're interested in let's say, running a subscription, a boxed vegetable scheme where you're going to make deliveries now, find a couple of places that are doing it. Talk to those people, get their advice. Lots of times, and I'm sure, Ed, you'll agree with this, we get some novel question, and so we have a colleague that, an attorney that we know that's their field of expertise, so we get on the phone and we call them up, and they kind of walk us through it so that we know what kind of research to do, and it makes it much less expensive for our client than us spending hours and hours and hours in the law library trying to figure it out. So, find a good mentor, talk with people, develop your network.
Very good. Thank you both for joining us. Thank you for your service. And I am so glad that I got to be part of this series. With that, I'm going to turn it over to Beth for final words as we wrap up today.
Yes, well, thank you, Anne. Thank you for all of your assistance during this series. I appreciate your help every single week. And I also want to thank John and Ed for some great information today. I know I made several notes for my own personal knowledge and some situations. So I appreciate you being able to share your knowledge today. So I appreciate the people that joined us for the series, and this too will be posted. I'll share a link on our Facebook page, and then also it will be posted on our YouTube channel. So thank you for attending, and thank you all.
Thank you. Have a good day.
Thank you.